What is going on, guys? My name is Alex. This is the Equity Odyssey podcast, and today I have the pleasure of getting to interview Mario Dattilo. We actually initially met at a Southwest Florida RIA event, and Mario is just a wealth of knowledge on mobile home parks, mobile home park investing, and he's been in the real estate game a long time, over 17 years, and over 1,000 mobile home lots invested in. So super excited to have you, Mario.
Hey, excited to be here, Alex. Thanks for inviting me to do this. It's going to be fun. Let's dive into it and make sure that we give these guys a ton of value.
Awesome. So the Equity Odyssey. So really we like to dive into the highs, the lows, the key turning points on this journey and really what influenced you and yeah, just key events. So from my research and from, just knowing about you a little bit, you started flipping houses. Is that right? That's kind of how it all started?
Yeah, I started a business in high school. So I was 18 years old, just turned 18, still in high school, started a marketing business, did really well with that for probably 3 years. And then the company that we were contracted by filed bankruptcy and they cut off all income streams to my business. And that was just a rude awakening. And that's kind of what pushed me into real estate. Started out in the real estate brokerage business and the mortgage business, and then transitioned into house flipping. So you're right. My first kind of stab at real estate investing was flipping houses with my dad. He was in construction his whole life, and I had kind of the transactional background from the brokerage business. We got together and we're like, okay, we should probably partner up. This is 2008. We should partner up. We should start buying this distress stuff. And instead of me just helping clients do it. And so you're right. Flipping houses really my into real estate investing.
Awesome. And how did that go? What made you eventually transition out of it?
Yeah, I mean, we were investing in single family homes, flipping them, at pretty high volume actually from 2008 to about 2013. And then we realized that, it's good money, but it's a job.
Mm-hmm.
And you have to continue to source deals or you're out of business. And the problem with that is there was no end. It was you're either going to continue to source deals or you're going to be out of business. And that just wasn't fun. You start to get burned out after a while. And keep in mind, 2013, it's kind of the end of all the distressed assets. And we're starting to get back into traditional home sales where you're just getting with mom and pops who have motivation due to divorce, death, things like that. But there wasn't all these distress sales from banks. And where we really thrived was buying, REO, non-performing loans, things like that, where we could do it kind of at a more predictable pace and we had a business model around it. So we would have had to change our entire business model. And we saw the writing on the wall that was happening. We were going back to, bandit signs and flyers. and that just wasn't fun when for the several years before that, it was just a feeding frenzy and it was just getting more competitive. And so we started looking for apartments actually. Obvious reason because we were familiar with residential tenants. Like, well, we'll understand that tenant base, or I shouldn't say tenants. We understood that buyer from when we were flipping houses. So we figured we would understand that tenant. So we started looking at apartment buildings, did a bunch of research, actually took some education on it and looked for about a year and a half unsuccessfully. Couldn't find any apartments and was pretty burned out at that point, just trying to find a good deal on apartments, which now anybody who knows kind of what was going on then, you look back and anything we would have bought back then would have been a home run deal for us. But hindsight's 2020, right? And we were being conservative and playing it safe. And at that time, nobody was really excited about real estate. So you got to play it safe. And I stumbled across my first mobile home park deal. A commercial banker buddy of mine brought it to me actually in Naples. And he's like, hey, this lender is getting ready to foreclose on this mobile home park. It's in your backyard. You want to take a look at it? I'd bought a lot of non-performing loans before. That's what I did. I bought the note from the bank, foreclosed on it, took it back. And that was my first mobile home park deal. Made a lot of money on that one.
Awesome. That's super cool.
Yeah.
So the House flipping, you kind of realize that was more of a job and less of a, something that's buildable. And also the acquisition was certainly making a dramatic shift there. So you just started
Yeah.
looking at other assets and stumbled upon mobile homes. Awesome.
Yeah. I mean, you can, after a while, you realize that every time you sell an asset, the work starts all over again.
Yeah.
Like I hate selling real estate. I hate it because it takes so much work to find good deals that when you've got one and it's paying you to own it, sucks to sell it because you got to start all over again and that income stream stops. So, you know, we just had to keep buying more and more to be able to make anything. And we just wanted to get to a point where we were generating good cash flow. And side note, we didn't want to buy single family for rental because the dollar amounts were so low. And from a management standpoint, it's pretty intense. Scattered site, single family homes.
Yeah.
That's a mess. We didn't want to have hundreds of roofs to deal with and hundreds of, we just wanted the scalability of commercial real estate, which is why we were looking at apartments. Also, we wanted to get into commercial real estate because the valuations are different. You can buy single families and rent them out, and that's cool for cash flow, but they're only worth what the house next door is, where you can't force appreciation up no matter how much work you do to it, no matter how much rent it produces. It's really only worth so much, which is based on a comparable sale, where commercial real estate, every dollar you put to your NOI forces the value up and there's a multiple on that. So it's just so much more profitable. If we wanted to get super wealthy, commercial real estate was the clear path for us.
Right, right. So you kind of by happenstance stumbled onto the asset class of mobile homes. How did that first deal go? You made a lot of money, so that's always good, but I'm sure there was lots of there was probably a learning curve. I'm sure you found out about a couple of things. Tell me about some of that.
Yeah, that deal was a very complex deal. Buying the debt, foreclosing on it. We did a workout with the borrower where he actually paid us to get off of the personal guarantee, paid us well over 6 figures to take his name off the loan and be able to walk away without us going after him for a deficiency judgment, which made us a lot of money. It really, what it did is it reduced our basis. We paid, call it $750, something like that for the deal. And then he gave us 130. So that put us at low 600s for our total investment. And then what we did is we took the cash flow. That was a ridiculous price we bought it for. We took the cash flow and we reinvested to make physical improvements. We did have some money set aside for it, but being new, we didn't really have a lot of cash set aside. We just kind of figured, okay, well, if we can make this much per year, we'll just set that much, we won't take any distributions for a year or so, keep rolling it into the property. I would never do that again. That's a very risky way to do it, because if the cash flow wasn't as predicted, we wouldn't have had the money to do the improvements. But thankfully, we did, and so we improved. We did the roads over. We put in parking spaces. We brought in some homes, filled the vacant lots. We built back water, sewer. We never built back trash at that property. We fixed some water leaks. We did new signage, new very large kind of decorative fence. All these things to kind of improve the look and feel of the property to attract a better tenant. We raised rents, all of that, and I would say the surprises, interesting thing on that deal, might say, well, man, if you got such a great deal on that property, how does that work without all, having to compete for it? Well, number one, I've never bought a park on market ever. Never bought a park or storage facility on market. It's always been off market, direct with owner, one way, shape, or form, right? But with this one, it was unique because the owner was trying to sell it. He had like 4 point something million on it. Okay. He was over leveraged is what it was. And he couldn't sell it because every time somebody would tie it up and try and do a short sale, they would later find out that there was over $1 million in code enforcement liens on the property. Code enforcement liens don't go away from, a short sale with the bank. That's still there. So they could never make numbers work once they hit that wall. So by us going around the back door, buying the loan, we went under contract on the loan. Then we went to the county. we actually had a construction company, that guys that were friends of ours that had done a lot of work for the county, and they were doing consulting work for the county. So we kind of hired them as a consultant and said, hey, let's get a sit down with the county. Let's work out a deal that if we do these things, they'll remove their code enforcement lien, or not remove it, but they won't reissue that lien. And we were going to foreclose out the lien anyways. We just didn't want them coming back after us to then hit us with hundreds of code violations and be back in the same position again. So we did. In our due diligence period, we went to the county, worked out a deal with them, got that papered up. Then we went forward with the closing on the loan, buying the note, and then we foreclosed it out. And the county was very happy with us. Actually, the commissioner contacted us probably a year or so after we'd bought it and wanted a meeting with us, my partner and I, just to find out, like, how did we do it? Because that park, they wanted to level it. They just wanted it gone. And they actually wrote an article. She wrote an article, the commissioner wrote an article about kind of how we did this. So it's pretty cool. But so we learned up front, make sure that you've got all of your risks mitigated to the best of your abilities before you close. Because if you think about it, if we would have bought that note, we would have just foreclosed it out and got that property back without really getting things firmed up with the county, they may not have liked us. And then we would have been negotiating from a position of weakness where we already own the property and they can be screwing us over left and right. And now we're having to defend it, owning the real estate. We wanted to get rid of that first and get on their good side, because if they would have said, no, we're going after that property, then we would have known that, look, this is a pretty risky move because they're going to probably try and shut us down even after we clean it up. So, so that was a big learn on that deal. But, I'm trying to think of any other craziness that happened. I would say that a lot of the operational things that we encountered were just minimal. We were able to, because we were buying the loan, not the real estate, it was actually in receivership with the bank. And this is getting kind of technical. I don't know if people know what all this means, but it's basically in receivership. The bank had taken control, put a receivership in place, a receiver in place. And so we had court-ordered certified financials, which who gets that going into a distressed deal? So at least we knew the numbers were accurate that we were getting, and that was kind of a cool thing. But yeah, a lot of random learns on that deal. We ended up selling it for $6.5 million, and so we netted like 5.7 after paying off the debt. Yeah, that was a crazy deal, but they wanted it, and they were willing to pay way more than we thought it was worth at the time. So
yeah, wow. I want to highlight what you just said, actually, because that will help somebody for sure. Doing that due diligence in your due diligence period, and it's kind of complicated too. I guess I never really thought about, you did the due diligence before you bought the note. So there's like a due diligence period on the note buying as well.
Yeah, the contract, we drafted a contract, a note sale contract that with the bank to buy that debt. And we had it's a little bit different. It's kind of backwards than what you do with real estate. But yeah, so we had a inspection due diligence period to legal, financial, physical due diligence on it. Physical was pretty limited because we couldn't talk to the borrower.
Sure.
And we couldn't talk to the manager. We couldn't talk to any tenants. So we had to kind of just walk around carefully around the property, not tipping anybody off, and just getting as much information as we possibly could about the physical aspects of the property. We couldn't camera lines, water or sewer lines. We couldn't do some of the physical work that we would have normally done. But we had a recent phase one. We had a recent appraisal, I want to say that we had a zoning report from the bank when they wrote the loan. And we were stepping in as the lender then, you know what I mean? So kind of a unique strategy, but
awesome. Okay. So lessons learned, made a bunch of money. That's awesome. Good deal. Was there a low point? Myself included, but a lot of people, they go through the first like kind of big deal or their biggest deal to date so far. And sometimes there's a point that's like, what did I just get myself into?
Yes.
Did you ever have that feeling?
Yes. And it's funny, and some people are going to relate to this. At one point, everybody's going to relate to it, I think. When you're getting into something new and you're telling everybody about what you're doing, everybody's like, yeah, man, you could do it. Go do it. You need money, call me, right?
Mm-hmm.
Then you bring them a real deal. It's like, oh, sorry, man, my money's tied up. Like,
Yeah.
no money available. Everybody who you thought trusted you had a reason to not give you the money. And you're like, this is a home run. Like, now I didn't know we were going to sell it for 6.5 million, but we knew that it was a really good deal. And we were doing everything we could to minimize the risk. But it's funny how quiet everybody gets when you call them to actually write a check and commit to doing the deal. There's a difference between, cheering you on and committing to participating in the deal. And so actually the crazy thing is the partner that I brought into that deal, I didn't know, never met him.
Well,
I was scrambling for money. I thought I had, access to enough capital to take it down. But once I started making those calls, everything dried up. And what I ended up doing was calling all the people that I could come across, that I could find that were in real estate at a larger level in town. So I think I looked up developers in town. I looked up commercial real estate investors in town. This is all like Southwest Florida local.
mm-hmm.
And I'm just trying to find somebody who's going to recognize the value, because this property was prime real estate too. I'm like, somebody who's local is going to see the value in what we're doing and what we're buying, even if they see it just as a redevelopment play later. And so I was just pitching people that I did not know, like, at all. I'd reach out to them and be like, hey, I know you don't know me. I'm buying a mobile home park in the area in Naples, and I want to sit down with you. I can tell you're a developer, and I want to see if maybe we could joint venture on this deal. That's it. Like, you know, and by the way, I'd never bought a piece of commercial property in my life. So neither did my dad, who was my partner in that deal. So I ultimately ended up partnering with a local real estate developer who had done some pretty awesome projects in town. And he just, I think the way he looked at it was, if this kid is crazy and can't pull it off, at least I got some really valuable dirt at a cheap price, and
Yeah.
that was his downside risk. And I literally talked to him today. He's still a great friend of mine. And, he really is the one that sparked off my commercial real estate career, because he took that chance on me. But yeah, so the learn there, or the down point, was going, what did I get myself into? I've got no money. I can't buy this thing. And I'm doing a deal that's more complex than I've ever done in my life. It's not just a commercial property I'm buying the debt with all this,
And foreclosing. Yeah.
And I'm deep into this. I'd foreclosed on a lot of loans before, but they were residential loans, small, lower risk kind of things, a lot less complex. And I'm like, man, I'm deep into this thing and I don't have the money. So thankfully he came through and took that risk with me. And he made a lot of money on that deal.
Yeah.
It paid off. Now I have a hard time getting him into more deals, because his expectations are like, now he's looking for a home run on every single deal. I'm like, no, that deal was uniquely awesome. Okay. So you can't do a 38x return on every deal.
Dang, that is super scrappy. I love that, and I want to highlight that for the audience, because they might not have been in that situation or understand what you did, but that's scrappy. That's impressive. That's awesome. Just in Southwest Florida, just calling developers like, hey, I got a deal. Like, you want a piece of this kind of thing? That's awesome, man. Props to you for that.
Thank you. And if you think about it, the capital couldn't be collateralized. Like, if you were just buying a property, you go, hey, we'll just give you a first lien position or a second lien position on the, like, there wasn't, because I was buying the note.
Oh, yeah, I didn't
it was a
think
very
about that.
unique structure, because we were buying debt instead. And someone who doesn't know you is like, all right, so how do I protect myself in the case that you lose your mind, because you're just as risky as the deal is to them,
And and also with the filter of your foreclosing, so there's a large group of people who are uncomfortable, unfamiliar with that process too. So that overcame that as well.
For sure. Yeah,
That's awesome.
it was a complicated deal. We earned every single penny of that
Yeah,
deal.
I believe it. That's so cool. Awesome. So that deal happened. Learned a lot. Made some money. Made a friendship, partnership.
Yep.
Where'd you go from there?
It's funny because once I figured out how awesome mobile home parks were, I kind of dropped the idea of buying apartment buildings. I'm like, no, I need to go find more of these. Now I didn't wait to sell the property. I owned that property for 5 years. So within, call it 7 months, I was under contract on another one. Keep in mind, mobile home parks were, the redheaded stepchild of real estate in 2014. Nobody wanted to own a trailer park. It wasn't even on the radar like it is today. Now it's obviously more competitive. You got a lot more people looking at it, and it's become a lot more institutionalized. But back then, nobody wanted to own a trailer park. And so it's great because I was picking up a ton of deals that were just under the radar. People weren't looking at. We went and did several deals, all pretty distressed. Pretty much everything we've bought has been either value add or distressed at some level. And that's really where the money's made. If you're buying really clean properties that take no vision, no risk, but no vision and no elbow grease, you're probably not getting a very good deal right now.
Hmm.
You're
Right.
probably paying a premium for that cash flow because it's predictable.
Hmm.
And we've just gotten very creative. We've gotten to the point where the hairier the deal, more than likely, I'm probably going to make it work because other people just don't want to touch it. And it's worked out well for us.
Yeah. Awesome. Is there a couple of things that you have like this is my go-to playbook when I'm buying a mobile home park to increase the NOI? Like, is there a couple of favorite moves you like to implement?
Yeah. So we typically will buy it with bank debt going in because banks are more flexible and they're also willing to finance part of the improvement dollars usually. So we can leverage a little bit of that, which helps returns. And then, we're typically, first thing we're doing is we're billing back utilities. We're making physical improvements first. I mean, right away, we're going in and, trying to clean it up, do roads, signage, trees. We're fixing water leaks as quickly as possible because that's liquid gold going out into the ground
Hmm.
that we're paying for. And then we'll submeter the water so we can bill back water, sewer. We bill back trash right away, usually, just to give the residents the responsibility of what they're using, right? I mean,
Hmm.
it's not, if you don't, they will use tons and tons of water and it will cost you dearly. As soon as they're responsible for it, you'd be amazed. It's usually a 30% plus drop in usage because now they're getting a bill for it and they're more
Hmm.
conservative in what their usage looks like. So we bill back utilities, and then once the property's cleaned up, we're raising rents. Yeah, we're bringing rents to market. And I gave an example last night on a presentation that I was doing, and it kind of broke down, and I don't have it in front of me. Otherwise, I could give it to you. But if you look at it this way, every dollar that you add to the bottom line to that NOI, you're getting a multiple on that. And so, for example, if I can add, $1 at a 7% cap rate, then I'm creating $14 in equity for myself. Not only do I get the dollar to, in my pocket from cash flow, but I'm also creating $14 in equity for myself.
Hmm.
So it becomes a game of how many of those $1 bills can I put to the bottom line to create the wealth. It also sparks the thought of that people need to think about. This might be controversial. A lot of times people say, start out small. Buy a 1 unit, 3 unit, 10 unit, whatever. Buy the smallest you can get comfortable, work your way in. I would argue that that's riskier. The less units you have in a deal, the less diversified you are. Okay. If you buy a 20 space mobile home park and you have a water leak, you're going to feel the repair costs so much more on that NOI and your cash flow than if you buy a 100 space park. You might say, well, that's, way harder to buy a 100 space mobile home park. Not necessarily. It's about the same amount of work. And actually, the lending is easier and the equity is easier to raise because people see the scale. And so it's actually it's riskier to buy small. So if anything, I want people to think about diversification of their tenant base. Let me ask you this, Alex. What's riskier? Okay. Not a trick question.
Okay.
A 50 space, 20 space mobile home park or a single tenant triple net lease with a credit tenant?
Oh goodness. I'm not experienced enough in mobile homes.
It's a triple net, like a commercial tenant, like a CVS.
Okay, that
So a
seems pretty low risk.
single tenant CVS building, triple net, no expenses, single tenant. What would you say is the lower risk there?
In terms of lost income?
Yeah, default. Like what's the
Oh yeah.
which one's a lower risk of losing money?
Probably, the CVS is going to be highly reliable, but there's only one, and versus if there's 20 of the mobile homes,
Yeah.
um,
So why do people pay such a premium for the triple net single tenant CVS over a, gritty 20 space mobile home park?
right.
They're paying a 5 cap. I'm using, kind of random cap rates, but they pay a 5 cap for the CVS, but they pay a 8 cap for the mobile home park. Which one's riskier? I would argue that the CVS is far riskier because you've got one tenant. And if that tenant defaults, yeah, you might say they're a credit tenant. They can back it even if they're going to move out. But there's a lot of major businesses that are not around. Think Blockbuster. If you said, a long time ago when Blockbuster was around, I don't remember when they went out of business, but if you were to say Blockbuster single tenant, that's a very safe deal. But you would no longer say that that is a safe deal, right? So industries change, economies change, especially with technology, and that makes single tenants much riskier than multi-tenants. So I would say go larger. And also for every tenant that you raise $10 a month, you're getting significantly more in value creation. If you have a 20 space park versus a 100 space park, if you raise the rents $10 across all the tenants, you make way more money in value creation on the 100 space park than a 20. So my rant is over, but I would encourage people to think bigger and go as big as they can within reason, that they can handle. Go do the biggest deals you can do that you can actually handle.
Right.
And successfully transact on.
Heck yeah. I love that.
I'm giving you permission to go crazy and do a bigger deal because it's often the same amount of work, but less risk and more gain.
Right. That is going to be powerful advice for a lot of people to hear, I think.
Yeah, smaller is not necessarily better. Same thing. You could say, what about a 10 space, 20 space mobile home park, 100 space mobile home park versus a single family home? Which one's riskier? Single family home all day, every day, because you go from 100% to 0% occupancy overnight if that tenant moves out.
Gotcha. Okay, awesome, man. I know we're kind of getting close to coming up on time, but just another tactical question for you. Mobile home parks, right? You kind of have the option owning the home, just owning the lot. Which do you prefer and why?
Don't want to own the home. We want to own the land only, and we want the resident to own their home and pay us lot rent. We want to be like a homeowners association as much as possible. We want to maintain the land, common area, infrastructure, amenities, things like that, because our maintenance costs are significantly lower. If you think about it too, if you've got renters in the homes and they move out, you now have vacancy, right? And you probably have turnover costs, make ready costs like an apartment building would, where if you think about like a homeowners association, the homeowner sells their home to the next buyer, the dues don't stop, right? The homeowners association doesn't miss a beat. Well, I want to be like the homeowners association. I don't want to miss a beat. I want the homeowner to sell it to another homeowner and me continue to collect rent in that transition period and never have to make the unit ready for a new resident, right? So it's significantly more stable when you don't own the homes. Do we get homes? Sure. We get them back, and sometimes, we've had to rent them at different times, not a lot, but we're typically not buying homes, bringing them in to rent them. We're typically selling every home that we get.
Gotcha. Awesome. I always like the tactics interest me. So that's super cool. I love getting your perspective, especially with how knowledgeable and how experienced you are too. But
one thing about that too is people look at it and go, well, you get a lot more rent if you rent the home. But what they don't realize is your expense ratio goes up a lot too. You go from, call it 40% roughly to 50% expense ratio with a lot more management involved.
Yeah. A lot more man hours for sure. A lot more repairs.
Staff, payroll, turnover. Yep, exactly.
Yeah. Leasing agents, maintenance crew, all that stuff goes up. So
exactly.
Awesome. Okay, man, this was, I think probably pretty powerful for a lot of people. Is there one thing or one message you want the audience to walk away from this podcast with?
Yeah. Don't think that you got to do it all yourself. I built it all myself, meaning when I say myself, I had a partner. My dad was, good at construction, so he handled all the construction aspect, but I built out a management company, built out a dealership, built out all these businesses to support what I'm doing, when really I should have been not being good at property management. I should have just partnered with somebody who already had good property management in place and partnered with somebody who was good at things that maybe I wasn't so good at, turned it into more of a team sport and focused on my unique abilities, which would be, sourcing deals, negotiating deals, and then raising capital. And if I would have just focused on those two things, not all the operational aspects that I'm not good at, I probably would have scaled significantly faster than I did. But because I took on everything, it was just a gradual stair step up. So I would say look at what you're good at, figure out, take a predictive index personality assessment, something like that, figure out what you're really good at, find your sweet spot, find one or two other people that are great at the things you're not at, team up and grow your business that way. And you'll scale significantly faster with a lot less brain damage.
Yeah, no, I've learned that lesson. I'm, there's levels to this, but continuing to learn that lesson too. When you just focus on one skill, you can grow so much faster. And then, if they're growing so much faster at the same time in the other, complementary skill, and it works so much better.
Yeah. So, and you actually make more and get bigger that way than trying to own more of a deal.
Right.
But, stress yourself out and grow slower.
Yeah. Yeah. Awesome, man. Very good. You have, a very awesome, I think, very value producing LinkedIn page. I will link that for sure. Cool. I believe you have a website as well.
Go to mariodattilo.net. Mariodattilo.net. It has my podcast, has my YouTube channel, has my education company, has the investment company, has all the businesses, everything that I'm doing, interviews, anything like that, it's all there. So check it out. If I could add some value, I'd love to do that for your listeners. Thanks for having me on.
Yeah, man. Thank you so much. I will link that in the description so everyone can access it easily. But other than that, man, I really appreciate having you on, and it was an extreme pleasure.
Same.
Awesome. All right, signing off, you guys.